Well, gross domestic product, or the sum of all the goods and services produced in Australia, increased by 0.2% in the 3 months to the end of September, which compares with the 0.5% that economists had forecast. Not great, but not a recession, so that's the good-ish. The bad is that Australia's economic growth is entirely due to immigration. On a per-person basis, GDP went down by 0.5% for the second quarter in a row, so that's what they call a per capita recession. And the ugly is the GDP per hours worked, which is the main measure of national productivity, fell even more, 0.9% in the September quarter, on top of falls in both March and June. In fact, productivity has declined a disastrous 6% since March last year. But we need some graphs, don't we? Here's GDP growth since before the last recession. Looks okay, right? But here it is, divided by population, GDP per capita, since the 1982 recession. It's been declining relentlessly for 40 years. And the story of what's happened lately is that household disposable income has collapsed, down more than 10% in 2 years. The dollar went up a bit today, which is weird because weaker GDP growth suggests less chance of another rate hike. But I think what's going on is that the market is factoring in American rate cuts. And that's why the share market is hot at the moment, up 1.6% today, which is the equal biggest one-day rise this year. There was particularly lively buying of banks and retailers today. Wall Street stocks eased overnight. And on commodity markets, oil, gold and copper fell while iron ore went up slightly. And that's finance.